a lot of GPS, they have points of interest, sort of landmarks as you go along, and some of them are very useful. This one is showing where is the next gas station. So if you're running low on gas, this is something you want to have. Some of these points of interest are not very useful, like this one showing you, well, maybe it's very useful, but showing you where the next McDonald's is. On our GPS, we have some points of interest, namely Bitcoin, marijuana, and passive investing, and we're going to go through all of these. So let's start with I'm going to go back. Let's start with Bitcoin. So you can see this is a chart showing the price of Bitcoin in black versus other historical market bubbles. And you can see not only does it look like Bitcoin's a bubble, it looks like it might be being the biggest investment bubble in history. So now a lot of the time why people say that it's justified to see this kind of price increase is they start talking about blockchain. But understand, blockchain, I'm not even going to go in and describe what blockchain is. It's a platform technology that Bitcoin uses. So you don't need to, if you like blockchain, and we think blockchain is going to be an exciting technology that will be used, but you don't need to own Bitcoin to take advantage of blockchain. Blockchain, or rather Bitcoin, why people own Bitcoin is it's either a digital global currency used for everyday transactions or it's a store of value. And we don't think it's either. It's not used for everyday transactions because it's too slow and too expensive. And also, who wants to have used for everyday transactions like a saving account, a vehicle that can go up or down by 20% in a day? It has too much volatility. We don't think it's a store of value or a gold alternative because even though Bitcoin is limited to 21 million tokens. So that's why it would be viewed as a store of value like gold, because it has a limited supply. Presently, there are about 16.5 million tokens that have been mined. The reason why we don't think that's true is because there's actually no limit to the number of new cryptocurrencies that can be created. And we also think that even Bitcoin itself, different versions of Bitcoin can be created through a process called a fork. So we don't see it as a store of value. We also have some concerns with the amount of energy that it takes in the mining process to create new Bitcoins. Presently, it's estimated that it takes the same amount of electricity that the country of Algeria uses in order to mine new Bitcoin, and it's going up every day. So we think that's unsustainable. So why are people buying Bitcoin? Well, because it was going up. And it's this idea of fear of missing out, this greater fool theory where you buy it today to sell it to someone else at a higher price tomorrow. And probably my best quote that I like on this is from a Charles Kindleberger. He says, "There's nothing so disturbing to one's well-being and judgment as to see a friend get rich." How we think this is going to end up is it's got to be more regulated. And you can see from this quote, MIT study shows that about 300 million of new ICOs, which is how new cryptocurrencies are created, it's a cross between an IPO and a crowdfunding, about 300 million of these were frauds or scams. And I've got a good example of this. And this is right from their website. It's called the Useless Ethereum Token. So Ethereum is a type of cryptocurrency. They claim to be the world's first 100% honest Ethereum ICC. They say you're going to give some random person on the internet money, and they're going to take it and go buy stuff with it, probably electronics. To be honest, maybe even a big screen TV. Seriously, don't buy these tokens. So they're warning you. You don't want to buy these tokens. They have a section of frequently asked questions. I'm just going to read out one. It says, wait, is this a joke? Is it a scam? Neither. It's real, and it's 100% transparent. You're literally giving your money to someone on the internet and getting completely useless tokens in return. There are no white papers, no products, and no experts. It's just you, me, your hard-earned ether, and my shopping list. This offering went on to raise $300,000, or as they say, enough to buy 230 TVs. It's no wonder their company logo is, yes. You don't need to be in cryptocurrencies. I'm fine if my neighbor gets rich. I hope they do. They can fix their house up. Now this chart, moving on to cannabis or marijuana stocks, this came from an article, a cover story in Barron's about 2 weeks ago. So you know you're in trouble when you make the cover of Barron's in a negative story. It's like 60 Minutes news crew coming to your office. It's never a good thing. And it looks suspiciously like a bit of a bubble as well. And in fact, this industry barely existed 3 years ago. Now it's got a cumulative market cap of about 30 billion. The whole entire gold mining sector is about 60 billion. We think this has got a bit ahead of itself. If we look at this table from the same article, you can look at what these are major companies in the TSX and what they earn, and they don't earn any money. In fact, they lose money, and yet their valuations are absurd. We get the demand side of this story. And if you look at what Constellation Brands is saying, they think this is about a $50 billion market in the US. They think it can get to $200 billion globally in 15 years. Let's put that in perspective. The wine market is about 60 billion and tobacco 75. So great demand. Same for Canada. Deloitte believes after legalization, you're looking at about a $5 to $9 billion market. And if you put that in perspective, it's low if it's the rum market. The high end is assuming it's like the wine market. And they expect to sell at about $10 a gram. Great demand. I have no problem with what the demand projections are. It's the supply that I have a problem with. And you can see right now there are about 60 companies in Canada, public and private, that are growing marijuana. Health Canada has given almost 90 licenses. They've got another 244 in review. If you look at other places in the US, states that have also legalized marijuana, Oregon and Colorado, the wholesale price has dropped to 50 cents to $2. So it's the demand side that we don't feel you can accurately judge in order to decide what kind of valuation you can put on these companies. Ultimately, we believe this is a commodity business, low barriers to entry with no sustainable advantage. I actually would rather buy a company that is growing tomatoes because now all the greenhouses are not growing tomatoes anymore, they're growing marijuana. So we think both Bitcoin and marijuana has been very liquidity driven, and we think this last one is also the same, and it's passive investing. And I like this cartoon. It says, I see him, the very last active investor, so rare. Whatever he buys by definition outperforms. Because the idea here is everyone is investing passively, then the valuation distortions that come from that are going to make it very easy to outperform if you're a fundamental value investor. And we see this with the flows that have been going into passive investing. This chart is showing that now there are more benchmarks and ETFs and indices than there are individual stocks. And you can see active equity mutual funds have had about $1 trillion in outflows since the financial crisis. And it's almost the opposite for passive ETFs. You've seen 1.7 trillion in inflows, and 44% of all equity assets under management are now in passive mutual funds. So why is that? Why is so much money being going into passive investments? It's because active management is more expensive and it hasn't been able to outperform. So passive investing has been giving you as good returns as active investing. We think that's going to change as interest rates and liquidity is taken from the market. You can see from this chart, it's showing the percentage of companies on the Russell 2000 that earn no money. And right now at 33%, this is upwards of levels that we see during a recession. And the reason for that is that low interest rates have enabled bad companies to survive. With low interest rates, the differentiation between a good company and a bad company is not as great. As interest rates go up, there's going to be more of a dispersion, and active investing will again start to do better. If you believe that's true, probably the ultimate example of active investing is private equity. You can see from this chart showing private equity returns versus the S&P 500 and see how well it's done. That's not necessarily why we like private equity. We would assume private equity to do better than publicly traded stocks. And the reason is because when you buy private equity, you're giving up liquidity. Typically, private equity funds you're locking your money up for upwards of 10 years. But we think that has an advantage in what we think will be a more volatile investment environment, because that long time horizon enables a private equity investor to work with the companies they buy and hopefully add value over a longer period of time. They're not forced to sell when the market goes down. It has that advantages when you give a manager over a longer period of time that money. It also enables them to take their time in looking for investments. It's estimated right now that private equity has about $1.7 trillion raised in cash waiting for opportunities. If the market were to correct, that would be a very good opportunity for them to start investing that money. Now, of course, you need to find good managers to do that. If you're going to be in an active management, manager selection is key. So let's wrap this up. We see on the one side, where we are right now, we think the environment is still really good. So good roads, nice straight roads, but we do see some storm clouds on the horizon. We think, though, that it's at least 12 months away, maybe even 24 months or longer. We think that when we do get into the next recession, it's going to be a lot more challenging, however. But we think risk assets are still attractive until that point. I think you need to be vigilant and watching that GPS, watching for when we get to the end of that cycle in order to take some risk off the table. And we would avoid, particularly in this environment, I think any investment horizon environment actually, but you want to avoid investment fads. And we also think active management in this time frame will start to outperform again. So in terms of my presentation, we have reached our destination, according to my GPS, but I'd like to pass it over to John Nicola, our CEO.